Okay, Tyler Crow. I hate to say it, but you and I both we're kind of right. We did a video a little over a week ago on NextEra Energy Partners, NextEra Energy. This was before management presented their plans for their capital plans, slashed their growth rates, and make some big changes that resulted in the stocks absolutely getting smashed. Tyler, you basically called it. You said, here's the realities, here's the problems. Management, they could have pointed at the video and said, just listen to Tyler because that's basically it. So the question I have right now, Tyler, that investors have to be asking, you look at how much these stocks are down. NextEra Energy, NextEra Energy Partners down 41% and 70% from their highs just this year. Is it time to buy on the dip? Tyler, you ready to have this conversation?
I am. I don't want to misconstrue what we said originally in that saying
And
like
we were
this was a
fortunate with the
bad
timing, if
business.
we're being honest, right? We were fortunate with our timing that we
Yeah,
recorded the video a few days before they did it.
right. So I'm not saying that it was a bad business to start with. What I was trying to get the point across was that the plans for growth and the way that they had been funding growth for this time was not a real viable option based on the way that the market was pricing its stock and the cost of debt that is out there today.
Things
Now,
changed and the company needed to change
change
with it.
course.
Tyler, before we get into the details here, I just want to remind everybody watching, the Motley Fool sponsors our videos. We're going to have a good conversation and maybe give you some ideas about how to invest and thinking about these companies right now. But if you're looking for even more great stock ideas, please go to our special link, fool.com/the smattering. You see it right on the screen. Motley Fool is going to give you its 10 best stocks to buy right now. Be sure to check out that link. Okay, Tyler. So let's go back to last week.
Hmm.
We did the video basically saying, hey, is this with the NextEra Energy Partners? Hey, is this a buy on the dip opportunity? Then we recorded a video for NextEra Energy talking about it as like a forever stock because a lot of times utility companies, you just buy it and you just sit on it and your checks come in every quarter and you can own it forever and you're going to make some modest income and you're not going to lose money. That's been very, very a different experience
Not the
for a lot of
case.
people. Yeah, yeah. So let's lay the case for what we talked about when we first recorded.
Yeah, so basically the case was being is that NextEra Energy Partners, which is NextEra Energy's financing vehicle, more or less for solar, wind, alternative energy investments, the way that the market was pricing it, it just didn't look viable, right? The yield on its equity was increasing, the yield on its debt that it would need to take on was increasing, and to grow at the rate that they were expecting to grow just didn't look feasible, right? When your costs of capital go up, you're going to be more stringent with the projects and the things that you're going to spend that money on because they have to generate a higher rate of return. Subsequently, after the video, a lot's actually changed in a couple of weeks here, and I think it's worth reevaluating, reconsidering what we're thinking about here, because management, what they have said is that we're going to basically slash our dividend growth rate in half. They were targeting in like the 10 to 12% range, and management even says, like straight up in the press release, it says tighter monetary policy and higher interest rates obviously affect the financing needed to grow distributions at 12%, and the burden of financing this growth has had on the impact of NextEra Energy Partners unit price and yield. So basically, they were admitting, like, look, in this current environment, we can't do this, and
Yeah.
so they've cut their distribution growth in half.
I want to emphasize that real quick too, because I've seen some coverage on the internet, which is just getting it completely wrong. And they're saying that they're cutting their dividend. They're not doing that yet. And they may get to a point where that has to happen. I'm not going to predict that at all. I still own some NextEra Energy Partners and I'm just kind of sitting on it right now. I'm not doing anything. So I'm not predicting that that's going to happen, but they've cut the dividend growth projections from, again, like you said, 10 to 12% is what they were targeting to grow the distribution every year, to about 5 to 6% is what they're targeting to grow. So they're still projecting that they'll be able to grow cash flows and grow the distribution every year. They're cutting the growth rate, not lowering the payout.
Right. And the other component of that too, and they mentioned, like we said, because yield or on the equity, basically the distribution it was paying was so high that its equity cost of capital was prohibitively high to, finance anything. And management even said in the press release that they didn't expect to require growth equity, basically meaning we're not going to have to issue new shares of this until at least 2027. So you know you're going to keep a lid on your equity issuance for at least 3, maybe 4 years, based on what they're looking at here. And obviously that means that they're just going to be, it's going to be a slower growth environment, which isn't a bad thing as long as you, the investor, are properly accommodated for the rate of growth. There's always two things when we're talking about dividend yields, or anything like that. You have two components. You have your income proportion in dividends, which is a pretty fixed amount of return on top of your dividend
Investors see it as the
growth
promise,
component.
right? Right.
Exactly.
And
So if I have a lot of fixed dividend yield, I can accommodate a small amount of dividend growth. But if I have a lot of dividend growth, I can accommodate a smaller yield because combined they're going to generate more or less equal returns. So now,
a good example of this, I think, is again, on the lower yield but higher rate of growth. Look at MasterCard, for example. The company's been public 15 years or so at this point, round numbers, and relatively soon after it went public, within a year or two, it implemented a dividend. Since it implemented that dividend, it's grown that dividend hundreds and hundreds of percentage points, right? Massive dividend growth. And the yield's still really low, right? Because the business keeps getting bigger, they keep growing their earnings, and the stock price keeps going up. So the yield stays low, but the rate of growth of that dividend is very, very high. You value that business very differently than you do a NextEra Energy Partners, which was saying, we're going to pay you a pretty high yield, but we're still going to grow it at double-digit rates. That's now saying, well, you know what? For the next 4 or 5 years, we're not going to grow it at a very, very fast rate. So that means you have to be compensated. In this case, we've seen stock prices come down a ton, right? For NextEra Energy Partners, and not as much, but still an incredibly big drop for NextEra Energy for utility. So as a result, for investors who are looking to deploy capital today, the compensation is that the yield has moved higher, assuming that they can maintain the dividend, right, and keep that promise. You're being compensated by getting a higher yield on your capital if you buy the stock now, right?
yes, and that in this repriced environment, it's about the return I'm going to generate, right? And now with this change dynamic in the pricing, where right now NextEra Energy Partners, based on its current stock price, has a yield of 11%. When I combine that with what appears to be about 5 to 6% dividend growth or distribution growth rate, with a business that seems reasonably fit to do this. Now, one caveat being, every once in a while, if there's one cockroach in the kitchen, there's more. So this is kind of my caveat of saying, look, at this pricing, at this yield, at this, the dynamic that they're setting out for management, this looks like an attractive opportunity. My only pause at the moment is saying, I really want to dig deep into the financials. I want to understand a lot of things like what kind of debt does it have? How much does it need to issue? What are the rates on its current debt? Does it have to refinance? Things like that. I think those are going to be very important things for a highly leveraged company. And so if those boxes can all be checked for me, then this might be a much more attractive investment today.
Yeah, I think that's the key, and that's a big reason why I'm holding right now. And I'm going to go through the exact same exercise because this is we as investors we look at a stock price and we look at the dividend and the yield and look at the balance sheet and the cash flows, and then we just take that picture and then we extrapolate it, right? That one moment of time, and we extrapolate it forward, and we forget that as we're experiencing, things can change, and a substantial amount of the debt that this company has issued in its existence came in this favorable interest rate environment, right? And unlike your mortgage, or the debt's amortized, right? And you get to the end of the loan and you paid it off and you own the asset and you're free and clear. Corporate debt or bond, all they're doing is paying interest. And then when it matures, guess what you got to do? Either come up with the cash to pay back the bond, the debt holders, or, and this is more typical, you have to roll the debt, right? You have to refinance it. So investors need to understand what those debt maturity schedules are. How is the company prepared to be able to refinance that debt and secure its balance sheet while also supporting the dividend? That's kind of where we are.